You know, if there's one kind of resounding CEO voice there that really kind of jives with what you're thinking about the economy, is there one that sticks out to you?
Well, it's a hard call right now, and Brad and Sean, it's great to be back on with you guys. The There's no doubt that interest rates are slowing the economy, and those impacts haven't really worked through the economy. You look at housing, and you would say that sales would have slowed down a lot. Prices would come down with these rates. Hasn't started really yet. Corporations who had generally a lot of cash haven't had to go and refinance with the much more expensive debt rates. So it will slow down the economy. The question is, will it be a recession or will it be a bad recession? And I think the short answer for me is it's hard to have a really big recession when everyone who wants to work can work and wages are going up. So I think the soft landing scenario is kind of where I would land. But certainly we're at an inflection point on what the Fed continues to do or stops doing.
So, Paul, if we do see that soft landing scenario that sounds like is what you're expecting, at least at this point, what does that then mean for Raymond James?
I think it's the same thing. I look at the client sentiment today, and over half of the clients don't have confidence in the equity markets right now. 80% have confidence in achieving their plan, and 95% good news is they like their advisors. So part of advice is working people through these downturns. It isn't always an up market. So it's not a lot of change. We have double the amount of capital to be well capitalized required by the Fed. We have twice the amount of cash we need to be highly liquid. So we will go through the cycles. So for us, it's still focusing on the long term for Raymond James, and more particularly is our advisors focusing on clients' long-term investment plans. So as of right now, yeah, we could have a downturn, but those tend to be cyclical. And the question is, like the company, advisors should be saying for their clients, what's the right path for you in the long term? So it doesn't change much right now.
Are you anticipating that downturn would be shallow, mild? How are you kind of quantifying it, if you will?
Yeah, so it depends on my hat, right? As a CEO and a company that's been through deep cycles being profitable, like '09, we made money every quarter. I'm paid to be a pessimist, but my personal outlook is I think it'll be a shallow recession. But from company planning, we always say, what happens if it gets worse? But I think it'll be a shallow dip. And the question is how long, right? We've had periods of stagflation before. If inflation, because of supply chain and other issues, doesn't really come down and the economy's not growing, you go through tough periods too. So you don't know, but my best guess, my personal guess, is more of a shallow slowdown for a period of time and then an increase. But any scenario you could argue.
Well, when you talk about some of the adjustments here that you are making, what more then does that look like when you brace for what sounds like is going to be and what is expected to be a very uncertain time for the economy here over the next several months?
Yeah, from a company standpoint, we're still focused on growth. So we have found in downturns when things slow down, it's easier to attract people because of our capital and cash. We can still invest, and we look at downturns as opportunities for future growth. Now, it doesn't mean we don't watch expenses more. We don't really do layoffs historically. We've had very few. We may slow down hiring, but we continue to work through those downturns and keep more people than most companies would in anticipation of the upcycle. And again, our capitalization and profitability, we've had our third consecutive year of profitability in three very different interest rate environments. So that's, we're built for those kind of fluctuations for the long term, and we're going to just focus on doing what's right for the client, increasing our support for advisors, recruiting more advisors. And, it may be a little faster, a little slower, depending on what happens with the economy, but we really don't vary from that focus.
And when you think about how advisors are engaging with those clients, what are some of and of course it comes down to an individual's portfolio, what their horizons are, but is there a prevailing kind of common denominator in some of the top ideas that are being recommended right now?
Yeah, so I think advisors really earn their money in the harder times in getting clients to do the right things. Very often, when there's a downturn, some people want to bail, right? And there isn't a retail investor, right? There are a bunch of individuals with different plans, goals, and risk tolerances. So, given their plans, what's the best course for where they are? So, you have seen shift from lower yielding cash to higher yielding cash alternatives, which you would expect advisors to do. Uh, but you haven't seen big pull. There's been an increase in fixed income because of that. But advisors, looking at the long term, have held clients generally in the equity market. So a lot of it is, look, you have a plan. Stay focused on the plan, not on the next few quarters, unless you have a particular issue or event you're worried about and you need to be very conservative to fund, hold the course. And I think that's the overall theme for advisors, and reassuring clients that they have a plan and you're watching, and the financial plan is still achievable given the longer term or middle term, depending on what their time horizon is.
Well, we're hearing from Fed Chair Jay Powell right now. He's speaking, obviously, on the economy. I'm curious to get your perspective. You mentioned the fact that the full impact of higher rates hasn't fully worked through the economy yet. Do you think the Fed should be done raising rates at this point?
Yeah, it's been an interesting cycle. I think they would self-admit they waited too long, left rates at zero for too long. And then they had to speed up, which had its disruptions. And you could see it in the banking system last March when rates went up too quickly and banks had to catch up. I think the last pauses have shown they understand that even though they haven't hit their 2% target and the economy is still good, that it's still working through. And I think they are doing the right thing by saying, look, and I thought they might do it earlier, but they're doing it now, the right thing by saying, look, let's let it work through. Let's see where it goes. If the economy and inflation stays overheated, we can always raise it, but let's not over raise it and then have to back off quickly because we put too much of a brake on the economy. And there's a lot of impacts. I mean, it's not just, it's capital rules by regulators, it's the Fed on rates. You don't want to close down the liquidity and lending system of the economy by having all these impacts at once. So I think Powell and the Fed have been very, very thoughtful. Of course, we're all working off of data and making assumptions, and we'll hear what he says, but I'm sure he'll say for now it's the right thing, but rates hikes may not be over because he's not going to declare victory at this point.
Too early to declare victory. All right, Paul Reilly, always great to speak with you. Thanks so much for taking the time to join us here this morning, CEO of Raymond James.
Thank you.